Stocks getting a nice lift this morning as President Trump delays the deadline for a 50% tariff on European goods to July 9th now from June 1st, saying in a post last hour that the EU has, quote, called to quickly establish meeting dates. Just the latest example of the fast-paced changes happening in the global trading order. Joining us now to discuss how companies are navigating all of it, Polsinelli attorney Deanna Okun and Baker McKenzie partner Jon Cowley. Deanna served as the chair and commissioner of the U.S. International Trade Commission for 12 years. Jon served as trade counsel for Apple and Nike. So we've got a perfect pair of lawyers here. Deanna, what are lawyers telling their corporate clients at this point about how to navigate all this?
Well, thank you for having me. It's a pleasure to be here. What we tell our clients is to ignore the noise and look at the details. So, we had this announcement over the weekend with the president talking about the February 9th, the EU tariffs, and then quickly pausing again back to July 9th. So, in terms of tariffs, it was just the status quo. And that's really how we talk to our clients, which is to say, let us look at what tariffs apply to your goods, try to think both short term and keeping in mind these deadlines, but longer term, like where do you want to be and how do you secure your supply chain? And I think that's a conversation that starts with the C-suite, but goes down to the logistics team, and then they need to be coordinated, and that's what we try to help them do.
But in the meantime, tariff rates are up, even ones that are delayed. We are seeing higher rates across the board. Jon, is there any way companies can legally not have to pay them, the ones that import stuff from abroad?
Well, completely avoiding them is basically out of the question. I think what companies are doing right now are one of three things, and probably a combination of the three. One is that, they're trying to pass this on, and the other is they're absorbing it. And the third is that they really are working to reduce the tariffs. And if they aren't successful in any of these, they have to think long and hard on whether it's even financially viable to continue importing those specific items. The strategies, though, are primarily twofold. We're looking at a lot of country of origin work. Companies are trying to figure out what they need to do to be able to confer origin in a country that's not subject to maybe quite as high as a rate. And then tariffs are assessed based on the values of products. So they're also looking very closely at their customs valuation to see if there's an opportunity to dial that back a little bit, particularly for non-product related costs that might be put into the customs value.
So is there a new industry starting up on tariff reduction strategies? I would assume there's a lot of companies that are looking for advice on those things. Jon?
Oh, absolutely. Yeah, there are a lot of companies that are reaching out. Now, we're very fortunate that we get to work with, companies that are really concerned about the risk management side of this, who want to make sure that they're falling on the right side of the rules. And so we work very closely with those companies to find solutions.
What about this first sale rule, which allows importers to use the price, I guess, of a first sale in a number of transactions to customize, to basically calculate customs duties and to make them less? Deanna, there's a great article on CNBC.com about how companies do this. When something's shipped from China to Hong Kong and then Hong Kong to the U.S., obviously the U.S. pays a higher price, but maybe will not have to pay as high of a tariff because they can go back to the original price. How does that work?
Yeah, sure. So that is one of the tariff mitigation strategies that Jon mentioned and that we counsel clients on, which ones are in a position to use that. And it can help, again, lower the total cost. Another strategy is to look at whether you're the importer of record. We spend a lot of time talking to companies about thinking about renegotiating contracts to split the costs because, as mentioned, there are tariffs in place. But again, I've been doing trade law for 30 years, so in some ways it's great to have companies really focused on the details now and ways that we can help them, first sale just being one of them. And then also, in terms of steel and aluminum tariffs, looking at the actual value of that product in what's coming over. So there are a number of things that companies need to be aware of. And the other thing I would mention, which I think a number of the companies that are watching this show, is if they're in the North American region, the USMCA, how to qualify. A lot of companies didn't pay as much attention to that prior to the IEEPA tariffs coming on and then the exemption for USMCA products. So that's another place to look at to see if the companies can mitigate tariffs using the exceptions that apply.
Hey, John, one thing, I don't know, I know you're not a logistics guy per se, but some have argued that even with this 90-day pause, container traffic, for example, from China to the U.S. has not rebounded as strongly as you might expect. I wonder, is there a certain level of clarity that clients will be looking for? Is it a memorandum of understanding? Is it just having talks on the calendar? Is it something legally approved by Congress before they can start making, short-term order decisions or longer-term CapEx decisions?
Well, companies are already making a lot of short-term decisions just because they have to remain in business right now. But the longer-term planning, I think they want to see a little bit more certainty. They want to see a little bit more that they could rely on, something solid beneath their feet. Right now, what we're seeing is really a rapid-fire change in tariff rates that make it extraordinarily difficult to plan.